Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Meb Faber, the CEO of Cambria Investment Management. Cambria manages a number of ETFs that in total have over $2 billion in AUM. Meb is also the host of an excellent podcast where he interviews people from all different corners of the investment world. I have been a listener of the podcast for years, but recently realized that I knew a lot more about Meb, the podcast host, than I did about Cambria. Accordingly, I was interested to chat with Meb about Cambria's journey to get over $2 billion in AUM, who the target audience is for the various ETFs, the Trinity portfolios that Cambria offers its clients, what is so interesting about shareholder yield strategies, and how Cambria differentiates itself in a now crowded ETF space. And without any further ado, here's my conversation with Cambria CEO, Meb Faber. Meb, I think a lot of people know you for your podcast, but maybe don't know that much about Cambria. So I'd love for you to go over Cambria and its approach to investing.
Yeah, man. Well, it's easy to look at today. We are, about 2.3 billion, 14 funds, over 150,000 investors, and kind of look at it as one of these obvious outcomes. But really, we joked on Twitter when our first fund hit $1 billion. We said, look, this is an overnight success, 17 years in the making. I think if you go back to university, I was an engineering student, studied biology and biomedical engineering. This was a really exciting time. So I graduated year 2000, turn of the millennium, and everyone was worried that the Y2K planes are going to fall out of the skies. And there was a lot of euphoria and mania about stocks. Feels a little familiar with little things going on today. My professors used to trade stocks during class, like out of a movie. These engineering guys trading, CMGI, Lucent Technologies, Cisco's. For the younger listeners, that's the NVIDIA of our day. And but it was an extremely exciting time in genetics. We were sequencing the genome. Craig Venter of Celera was battling against the Human Genome Project of the U.S. government. It was almost like an Elon U.S. government style, private startup corporation is beating the government at its own game. You have that with rockets today, So anyway, exciting time with technology, et cetera. I was certainly smitten with markets, and we had the biggest bubble we've ever seen in U.S. stocks right about when I graduated. And so I was going to go to finish grad school, and go get a PhD, but didn't have any money. So I said, you know what, maybe I'll take a year off, try to make some money before going back to school, and went to work for a biotech mutual fund that actually let me go to grad school at night. This would have been in DC. Did that for about a year. Then biotech stocks went down, I don't know, 60, 70, 80, 90% during that bear market. And I said, okay, this is really interesting world to me. I need to figure it out. I'm going to give it another year or two. Moved out to San Francisco / Lake Tahoe, which is under about 12 feet of snow right now, and worked for a startup commodity trading advisor that eventually went bust, as most startups do. And then that really was the grounding for a lot of the ideas and quantitative measures. I kept my career / my hobbies and academic underpinnings kind of reversed. And so my hobby became my career and vice versa. And so got further and further away from biotech, although it's still a big interest of mine on the private side. Moved to Los Angeles, which I assumed I would hate, to start Cambria. This would have been 2005, 2006. Started managing money right before the global financial crisis in 2007. We started out with private funds in separate accounts. Started writing at the same time, both on a blog, which still exists to this day, and academic papers. And so wrote our first one right before the global financial crisis on trend following. That paper quickly became pretty popular and said, hey, this ETF thing. At that point, people were like saying, you talk to an advisor, they say, EFT, what's this ETF? Even though they've been around since the late 90s in the US, they really didn't start to take hold till this past decade, especially. And so we said, this is pretty interesting. We got the offer to sub-advise on a fund, little known fact. Forbes, the media company, was going to move into the ETF space. And so we were going to partner with Forbes to launch an ETF. The date was December 2008. So let's just say that didn't happen. They decided not to, which is a shame because they would probably be $100 billion ETF brand at this point. But anyway, we sub-advised on one fund and quickly said, we have too many crazy ideas. We want to launch these on our own. Launched our first ETF in 2013. That was our shareholder yield fund. And fast forward, it's over a decade later, like many, 2 steps forward, 5 back, 10 forward, 3 back. I've managed to survive, and here we are.
And when I look at these ETFs, I'm really curious about the audience for them. So you talk about having 150,000 different investors. It sounds like it's mostly individual investors, but I'd also, love to hear about how these tools broadly can be used by institutions as well.
If you look at the ETF landscape, it's pretty well papered over at this point. And I mean, you can find small cap Chinese stocks if you want to place a trade. And so as people, a lot of commentators and media in general often say, why do we need any more funds? There's over 10,000 out there, include the old mutual funds. And I largely agree with that. That having been said, there's a lot of areas that we think are really interesting. And people often say, Meb, there's more ETFs than there are stocks. This is a crazy world to be in. I say, well, yeah, there's more words than letters. Like, what does that have to do with anything? Like, that's not a really relevant point. That having been said, look, when we're trying to launch funds, we use 4 criteria, and you've probably heard me say this, but for your audience, the first one, we only want to launch funds that don't exist or that we think we can do, quote, much better or much cheaper. And cheaper is hard, right? Like, you got the Vanguard ding of the entire space, which is you can buy a global market portfolio for like 5 basis points. So for listeners, that's 0.05%. Amazing. Best time ever to be an investor. So the default is that the beta of just buying broad asset classes is free. So if you're going to charge more than 0, which we do, and keep the lights on, you better be doing something that's either totally unique, so launching something that doesn't exist, or is much better or much cheaper. And cheaper, again, there's some pockets of the universe where Vanguard or others aren't currently competing. And better is obviously a subjective and a high ideal. That's hard to say, but we see a lot of funds out there that we think are suboptimal in their design. So that's the first criteria. So hopefully we're in this dark corner where there's nobody else. This is like a Peter Thiel sort of concept. Like, I don't want to be competing with State Street, BlackRock, Vanguard. I mean, look at this recent ETF Bitcoin launch. There was like well over a dozen. I mean, how many AI funds have we seen coming out? It's all these competitors. That's sort of my nightmare. Second is the concept has to be supported by a fair amount of academic and or practitioner research. So usually like our shareholder yield concept, there's dozens of academic papers. Usually we either curate and compile it or we do our own research and publish it too. In some cases, there is no academic or practitioner research and we're kind of doing the original research and publishing it. Third, it has to be something I want to put my own money into. And the average mutual fund manager has $0 invested in their own fund, which is to me insane. This concept of skin in the game, why you would want someone managing a fund and marketing it to individuals and yet they don't invest any in their own cooking, right? That's crazy. So I put all my public assets into our funds and strategies. And lastly, and this is kind of what you alluded to, is does anyone actually want it? And this one, you try to launch funds where you have a pretty good idea that people want it or there's a demand for it. But in some cases, you're creating a new category. My friends Wes Gray at Alpha Architect did this recently with their box spread ETF. I guarantee you 99.999% of advisors have never heard of box spread ETFs until this came out. And this is what, $1.5 billion fund already. So, there's some areas where you have to educate the marketplace and or be approach you're willing to let marinate for a little while as it gets built up in size over time. That having been said, doesn't always work. There's times where there's an idea that probably there's a universe of one, me, and I'm the only person that wants it, and everyone else is like, that's not a good idea. That's a dumb idea, Meb. So the market eventually decides too. But we got 14 out there, and probably not another half dozen coming down the pike here shortly.
My guess is that you discard X number at some point, right? That are in the pipeline. Like, what does it take to go from an idea that fits at least the first three of those criteria to actually becoming an ETF?
Yeah, I'll use it. Let's do a case study real quick on our oldest child, which is the shareholder yield ETF. We have some funds that are extremely plain vanilla and some funds that are extremely esoteric, complicated, concentrated, et cetera. And, 10 years ago, we wrote a book called Shareholder Yield, A Better Approach to Dividend Investing. And, I think it's one thing, I'm a quant, so I can write a lot of these back tests and historical simulations, and you can come up with any back test to say anything you want, right? There's a lot of famous literature that demonstrates, this sort of data mining on historical numbers to come up with whatever you want to say. You can always create great back tests, but to me, you have the philosophical underpinnings. And is it something you can explain to your high school age, or even younger in many cases, kids, nieces, nephews, this concept, and it makes sense? And so this was a market target that was extremely large, TAM, right? This addressable market of people investing in income strategies, dividend strategies. And this has always been a curiosity to me and a head scratcher as to why. I mean, this goes back to Modigliani in the 1960s talking about dividends. Why in the world people invest in high dividend yielding companies? And particularly in the US, there was a structural change. Like we hear always in the media, this time is different or something has changed, but pretty rarely is that actually the case. But in the US, there was, and globally now too, which is the method in which companies distribute their cash flows. So we wrote about this in a book, meaning share buybacks, and wrote about it in a book about a decade ago. But really, we said, look, this is the premier factor if you're looking at value cash flow type of strategies to sort companies. It beats every single dividend strategy that we can model historically. It beats high yield, it beats dividend growth, it beats dogs of the Dow, on and on and on, right? But it's one thing to put it on paper, and it's another thing to actually do it with real money, because there's costs involved, there's tradings, there's emotions, there's frictions, there's all these things. And so we launched this fund in the US as SYLD, and then we launched a foreign fund, FYLD, and an emerging fund, EYLD, and a small cap US MYLD, on and on. And my point being is that it definitely took, the better part of a decade for people to embrace that message, understand it. And it's like a, red pill moment is once you kind of get this concept of shareholder yield, to me, it's hard to go back to thinking in the world in terms of just dividend income alone. And for the listeners, it's the combination of both dividends and net stock buybacks. And the net word is important, particularly in this cycle with all the tech bros right up the road from us that are issuing a massive amount of shares through stock-based compensation. So you're also avoiding companies that are issuing a ton of shares, not just buying them back. It has a value tilt, it has a quality tilt, and even at the very end, it has a slight momentum tilt. That having been said, it's been a bit of a surprise to me to see how these funds have performed and not see a slew of competitors yet. I'm knocking on wood here. I don't know who will be first, whether it be BlackRock, Vanguard, or State Street. But eventually, someone's going to launch a shareholder yield competitor. But usually, these big ETF shops love to copy what's working. When you see a particular style or strategy raise money, you'll definitely see the spaghetti wall throwers, right? Where they'll just launch 20 funds and then close 15 of them for the ones that work it or not. So I think that to me is a good case study of a very plain vanilla strategy targeted. It's 100 stocks, long only in each case, targeting a very specific idea that most would think is wallpapered over already, as far as, there's hundreds and hundreds of dividend and income strategies out there. But this one has a unique slant that we think clearly is better and differentiated. So not a totally new blue ocean idea, but one that we think, is definitely deserves a spot and has its merit.
And when you're thinking about why that's working and what you're comparing it to, are you comparing that only against dividend like oriented strategies, or do you compare it against broader indices as well to say this is standalone? I don't care what your benchmark is. This is a pretty interesting product and philosophy focusing on shareholder yield.
Yeah. So SYLD in particular, it's the oldest, has done exceptionally well, both in its category and versus the broad market. That having been said, it's a value style strategy. Everyone loves to talk value, really, since the global financial crisis has largely struggled. I was listening to a podcast the other day, and they said since GFC, you spell value with 4 letters, not 5, as far as the performance. Like on average, it hasn't kept up. And the irony is you don't expect it to keep up when the S&P is doing 15% per year. My favorite chart of the last 6 months that we've been publishing is a 10-year rolling return on the US stock market going back 100 years. And then there's been 4 periods in history where US stocks have done 15% a year for a decade. And they all have names: the Roaring Twenties, the Nifty 50s, the internet bubble when I graduated university, and then today, COVID meme stock era. And on the backside of those was always more challenging times. And that's the way markets work. But this has certainly been a unique period and really fantastic for US-based investors and market cap-based investors and growth-based investors. That having been said, my personal belief is that when we look back to 2021, I think that's really will be marked as the inflection point for value for the better part of this next cycle. Could be 3 years, could be 5, could be 10. And I think value type of strategies will shine. But so on average, yes, this fund has done exceptionally well versus the broad universe of funds out there. Morningstar calls it a 5-star fund, which is sort of a way they have of looking back on trailing risk-adjusted performance. That having been said, we sent out an email last summer and this fall that if you look at the valuation of this basket, any investor, if you got a public fund, you can go toss the ticker into Morningstar and click on holdings, and it'll give you a X-ray snapshot of what that fund looks like as far as PE and cash flow and other types of valuations and growth. And what's interesting is that you expect dividend and shareholder yield strategies, value strategies, to trade at a discount to the overall market. That's in the name, right? And this fund has for the past 10 years. But in the past 4 years, that discount has widened, meaning the stocks in this fund have gotten cheaper or the stocks in the broad market have gotten more expensive, or both. And you now have near the widest valuation spread we've ever seen since this fund's been out. And you see all the big quants out there, GMO, Research Affiliates, AQR, all talking about these valuation spreads being in sort of top 10% of history, not just in the US, but global. And so usually when things perform great, you have multiple expansion. So the US stock market on a 10-year PE ratio basis back in 2009 traded at about 12. It's at 35 today. So part of the performance of the past 15 years has simply been people were willing to pay much more for stocks today than they were 15 years ago. And on average, that number is around 18. When inflation's low, it's around 22. So 35 is certainly high. But the value bucket has done the opposite, right? It's gotten cheaper. And so eventually this headwind becomes this headwind values will become a tailwind, and you'll have multiple expansion at some point. We just don't know when, of course. But we think that value in general and types of value companies, not just in the US, but foreign, developed, and emerging as well, will be a big beneficiary in the next regime, whenever that may occur. Maybe 2034. I don't know, man. We'll do this again in 10 years and see what happened.
what you're getting at is some kind of mean reversion, right? The pendulum has swung way too far towards growth and maybe momentum, and maybe swings back towards value. But like, you go on Twitter, you talk to people like you like yourself and myself, like there's always this like pontificating about when and how meaningful that's going to be. But I guess the question for you is like, do you need some sort of mean reversion to occur for these strategies to be successful? Because like I could look at it as a potential investor and being like, well, I get it, but it's not even just the securities having to perform. You also need some kind of external thing to happen to be a good investment. How do you think about that need for that mean
One
reversion to occur for even this to be worth investing in?
one of the biggest challenges for investors is the preferred timeline at which they want returns and certainty. Let's call it, I don't know, weeks, quarters, months, maybe years, year or two, and the timeline at which markets actually play out as far as what you think should happen is not just years, but could be decades. Ken French has a great quote where he says something. He's like, people that make inferences from 1, 3, 5, or even 10 years of performance are crazy, right? There's so much short-term noise. And this doesn't just apply to active strategies. There's an enormous amount of research showing that even the best managers, the top of the top, the elite managers, can go not just years underperforming, but many years in a row. But that doesn't just apply to active strategies, that applies to asset classes. And so we spend a lot of time talking on Twitter to people who think that US stocks are just going to go straight up 15% forever and always beat everything and put all their money in US stocks. And you can outline in history, there's been plenty of times where the opposite has happened. We have a post a couple of years ago called The Case for Global Investing, where we look at US stocks versus foreign. So everyone's going to tune out at this point in the show because no one cares about foreign stocks. But historically, foreign stocks versus the US has been roughly a coin flip. In any given year, it's about 50-50, which outperforms. You've had this monster period of US stock outperformance for 15 years. But in history, if you look at it by decade, so you go back 100 years, so you look at the US stock market versus other stock markets and then a sort of equal weight or market GDP weight of these other countries, the US creamed everything this past decade. We all know that. But from 2000 to 2010, US got smashed by everything. Gold, by the way, since I graduated university, has outperformed gold, REITs, and US stocks are about all the same. And I think we'll have to look it up to today. I'm not sure yet. But REITs and gold, last I checked, were doing better than US stocks have done. It may be close now. I think that would surprise people, though. But from 2000 to 2010, US stocks got smashed by everything else. Now, the 90s, of course, amazing, right? Great decade. US stocks creamed everything. And then before that, you have to go back to the 1910s. Not 1 or 2 decades, not 80s, 70s, but 60s, 50s, 40s, 30s, 20s, 1910s to find a time when the equal weight of global markets would not have outperformed US stocks. So people love to extrapolate. Japan is always the big example. I was just over there. Japan's stock market is finally reaching the levels that hit in 1989. This isn't some backwater economy. This isn't some tiny country. This is actually one of the top 3 global economies, top 3 stock markets, was the largest stock market in the world in the 80s. So I think the struggle that people have on when they want things to happen versus when they might happen is a big argument for diversification of not just strategies, but also asset classes, and then also having a little humility and humor as to what can happen in the interim. The markets are always going to be crazy. If you look at, there's always a bull and bear market somewhere, gold hitting all-time highs, and yet China's down 50. Bonds, some of these long-term bonds are down half and people aren't losing their mind yet, which is always odd to me because if stocks were down half, people would be losing their mind. But this period was also one of the worst periods. We wrote a book called Global Asset Allocation, probably about a decade ago too. All my books are dated before the birth of my son. So I kind of said I wrote about 5 books before he was born and 0 cents. But so that book profiled a lot of the top asset allocations that real professional investors espouse. So permanent portfolios, 60/40, risk parity, people that manage hundreds of billions. And all of these portfolios got creamed by the S&P in this cycle with the most years in a row of underperformance and the largest magnitude of underperformance in 100 years. So anyone, not just people who are not doing US stocks, market cap weighted, but anyone who diversified into other things, foreign stocks, real estate, bonds, commodities, gold, trend following, on and on and on and on, you struggled this cycle. But just to be clear, this long-winded diatribe is that's not normal.
And speaking of asset classes that have not worked, especially relative to the US mega cap space, emerging markets have been a painful place to invest over the last decade. You just talked about China being down 50%. So maybe talk to me about why a fund like EYLD, the Cambria Emerging Market Shareholder Yield ETF, could be an interesting vehicle for people to consider right now.
I was on TV the other day because everyone loves to talk about NVIDIA all day long now. And, rightfully so. Look, this is a company at this scale that's having these returns and growth. $2 trillion company is amazing. But I was trying to make this point where some friends of mine on Twitter, they also happen to be crypto people. They were saying, "Oh, you value guys, you're going to miss it all because you don't own any tech companies." I said, whoa, hold on. Look, the most famous value guy in the world has half of his portfolio in a tech company. So you can't really say you're missing it. But I said, yes, to be fair, on average, most of the value strategies don't have as much in US tech because on average, US tech stocks are expensive. So if you look at our SYLD ETF, it has very little tech exposure. Because it's sector agnostic, it's size agnostic, it can go anywhere. I said, but that's not true around the world. And most of the stocks are outside the US. Most of the best performing stocks each year, so it's like 75% of the top 100 stocks each year performance are outside the US. It's just a math game. It's just a numbers game. But I said, there's a stock we own, and I'm not going to say the name because it's unimportant. It's our largest holding in EYLD. That's a semiconductor stock. And I said, it's had better performance than NVIDIA since the beginning of last year. And yet, how how many tweets there's been about this in the past, since the year began? I said, there's one tweet that some guy tweeted about this stock. And so tech in the emerging market fund is actually the largest exposure, which is interesting for most value people out there. They say value doesn't invest in tech. I said, well, hold on. Value doesn't care about sectors. It just cares about where are the opportunities. And one of my favorite charts is if you look back for like the past 50 years and you look at tech as a percentage of the S&P, and it goes up and down. There's times when it's high and there's times when it's low, and it's pretty high right now. And then you overlay with energy. And there was a time when energy stocks were a third of the S&P 500, and today it's less than 5%. I think it bottomed at 2%, which is astonishing to me. Anyway, so emerging markets, have been a fascinating story to me because for a long time, they've been dominated by the China narrative, and no other country in the world recently has had the highs and lows of China. And let's be clear when we talk about the US. So for valuation on this long-term PE ratio, the US has been as high as 45, December 1999, and as low as 5 in a couple periods in history as far as PE ratios. And again, right now it's high. It's around 35. It's one of the most expensive stock countries, broadly speaking, in the world. China has also been a basket case. It was like in 2007, after this decade of emerging market outperformance, it was trading a PE ratio of around 50. It's now down around 8 or 9. All right. So 50% declines have a way of doing that, right? Where market's gone nowhere I think Chinese stocks have zero return for something like 30 years now. And to me, that's exciting. Like I love markets that are cheap and hated, and then we haven't really started to get into trend following yet, but adding in that uptrend part. So China's definitely not in an uptrend yet, but at some point it will be, whether that's this year or 5 years from now. And so China and India for many years kind of have had returns that are very similar. and they kind of oscillate around each other. And India has just gone absolute straight up, and China's gone straight down. So China at one point a few years ago, as far as percentage of market cap, was probably around half of emerging markets in some indices, or third on the low end, and India single digits. And now India is creeping up to almost 20%, and China's probably 25%. But you all of a sudden you have this scenario where those two could switch, which would be crazy to think about. If you would tell anyone in the last 5 years that, they would say you're crazy. But China certainly struggled. But that's the opportunity. And going back, thinking about investing in countries around the world, there's always the cheap countries are always a basket case of problems, what's going on. And then the expensive countries are usually hitting new highs, things are looking amazing. But on average, investing in the cheaper ones tends to have done better. And part of that is also you're avoiding the really expensive. So the times when buying Japan 30 years ago, when it's the highest of all the PEs we've seen, it hit almost 100. Buying that 30 years ago was a horrible idea. And yet every emotional signal was saying Japan is taking over the world. They have better companies, better products, which were all true. But the stock market just went completely, and real estate market went completely nuts in the 80s. But the crazy part is it looks really attractive now. And it's funny because you start to see some interesting sentiment signs out there that may mark as waypoints and shifts in how people feel. But Japan is certainly showing up on a lot of our screens today. But emerging markets are in the sort of the dustbin of allocators' history of the total global stock market. Let's call it their low teens, maybe 12%. I think the average allocation is like 2 or 3. And that rounds to zero. I think you ask most people, they'd probably say they have they have zero emerging markets at this point.
Concentration is something we talk a lot about on this podcast because it's a fascination of mine. You mentioned that China is really cheap right now. I'm interested, you're a quant, so my guess is you've looked at performance with different levels of concentration. How do you decide on how many stocks should be in each ETF, and how, like, what would stop you from saying, China should be a much higher, should be 50% of the shareholder yield ETF emerging markets versus the whatever 25% it is in other, emerging market benchmarks?
I'm going to answer this 2 ways. The first is the simplest, sort of like idiot's guide to asset allocation, the dummy's guide. You as an investor, you could just buy the world of capital assets, which is about half stocks, half bonds. We call this a global market portfolio. And of that, it's about half US and half foreign. That portfolio is really hard to beat, by the way. Most institutions, most individuals probably will underperform that portfolio. Incredibly diversified, easy to do. You can do it with Vanguard funds. You don't need Cambria funds to do it. And that is like the table stakes starting point for most allocations. Just as an aside, as people think about position sizing, how much to put in all this, it's also a useful construct when looking at new assets. Like my Bitcoin friends are always like, how much should I put in Bitcoin? And they want the answer to either be 100% or zero, right? They never want to hear me say, you know what, slot it in as a percentage of the global market portfolio. Let's call it 0.5%, 0.75%, right? No one wants to hear that, but it gives you a framework, at least from where to start with. Markets around the world, and this is mainly equity markets. We'll focus on businesses. There's a concept that I think everyone's always looking for the unique insight. And to be successful in investing, this insight to me, in really any area, you want to find what is the most important insight. Doesn't have to be unique, right? And so to me, with equities or with businesses, is they follow a power law distribution. And what do we mean by that? Is that very few percent, let's start with stocks, contribute all the return of all the stocks out there. So the reason a market cap weighted index works, where you buy everything, Vanguard, you just own the whole market, you're guaranteed to own NVIDIA. You can go to a cocktail party tonight and people are talking stocks, say, yeah, I own NVIDIA. I've owned it for years as a percentage of the market cap. And as it goes up, you own more. And as it goes down, you own less. Incredible invention in the 1970s, paved the way for low fee investing. That's changed today, of course. But the problem with market cap weighted investing is you have no tether to fundamentals. So when things go completely batty, like the US in late 90s, Japan in the 80s, China in 2007. And I wouldn't say the US is in a bubble now. I would simply say it's expensive. Market cap is expensive. To me, bubble is really getting over 40 on the PE ratio, which we're getting close. Looking at stocks, so of 100, maybe 5 or 10% are can contribute all the return. There's an old paper by my friends at Longboard called the Capitalism Distribution. You've seen the academic research embrace this idea since. So Besson-Binder paper, JP Morgan has one, and we can send you all the links on this for the show notes. But they've all confirmed this, which is, roughly about 2/3 of stocks out there underperform the index. Roughly about half have no return over their lifetime, and like a quarter basically go to zero. And so you have to own the big winners, the McDonald's, the IBMs, the Walmarts at some point, or things like them to have this fantastic return over time. That having been said, and the people that understand this more than anyone are my venture capital friends. They get the power law, right? So the Ubers of the world are going to totally determine the return of these funds. Now, I think people make an error on my venture friends and to a lesser extent stock friends. I think stock friends don't appreciate the power law as much, but it doesn't matter because they end up owning a lot more stocks. My venture friends or angel friends, they'll invest in 10 or 20 companies. And I'll say, look, man, if you're expecting only 1 or 2% to be the big fund returners, 20 is not enough. Like you probably need 100. In fact, 50 would be a good start, but probably 100 and honestly, maybe 200 to really guarantee you're going to own a few of these. And so public market investors usually own a lot more. So our funds all own 100 stocks on the stock side. I think if you were to say to me, Meb, could you do it with 50? I would say, yeah. I would feel a little squeamish about it, but could you do it with 200 or 300? Certainly. And then it just becomes a question of art, and optimization of like, how much feels like a reasonable amount. 100, something nice and just symmetric about that number. I don't know. And so we equal weight them. We let them float. On rare occasions, something will go crazy and go up a bunch, and we trim those. And then we rebalance it quarterly to make sure that we're bringing in new names and kicking out expensive ones. But we'll end up owning. We owned Apple for a decade, which is pretty cool. But really long-winded answer to your question, but I think it's important. And position sizing and portfolio construction is a topic that I think most investors that spend very little time on and thinking about it, and outcomes too. What happens if a portfolio position does great? What happens if one does terrible? Walking through the mental aspect when you buy something. So write it down like, hey, I'm going to buy NVIDIA today. Great. What happens if it goes down 80%? What happens if it goes nowhere? What happens if it goes up 5 times from here? Ditto with gold, ditto with Bitcoin, on and on. Because you could have the unfortunate problem, and everyone's going to have this because markets spend most of their time in drawdowns, positions going down, right? And then dealing with those emotions of how do you plan on handling that? But also the very real, wonderful, exciting case of what are you going to do if you start to get a stock that doubles or triples? Oh my God, amazing. Like I'm going to start thinking about vacationing in Cabo and buying a new car or whatever everyone salivates over. But you got to remember, every stock double or triple, every stock that is 100 bagger or goes up 100 times at some point was a double or triple first. And so unless you think about, hey, this is mentally how I'm going to think about this stock and how I'm going to think about trimming it or not, you'll never own something that goes up 100 times, which is life-changing wealth. I think that's a real 10 grand into $1 million would be a pretty amazing outcome for all of us.
And you mentioned the book about global asset allocation. You guys run what are called the Trinity portfolios that look like they're populated with both Cambria and non-Cambria funds. Maybe you can talk about those portfolios you offer and how they differ.
Yeah. So when you think of asset allocation, which is most professionals, financial advisors spend most of their time, institutions, doesn't matter if you're CalPERS or Norway, think about how do I allocate all my assets to come up with an optimal portfolio. Everyone loves to talk about 60-40, 50-50, whatever it may be. And I think as long as you have some of the main ingredients, pay low fees, or mindful of taxes, it doesn't really matter the exact percentages. And this is probably a non-consensus view. But the problem is most people, don't have the ingredients. So all our friends in the US own almost entirely US stocks and bonds, and that's it. It's not the worst thing in the world, but again, it tends to be suboptimal. Think back to 2022, really rough year for that type of portfolio. Because it missed two things. One, global stocks. It makes no sense for me to own just one country. And if you don't believe me here, American friends, get your passport and go travel to a bunch of countries and ask them, your friends there, say, hey, is it a good idea to put all your money into Brazilian stocks or Argentine or Russian or Chinese or UK or Japan, on and on. And they'll all say, no, are you crazy? Why would you do that? Japanese stocks haven't gone anywhere for 3 decades. UK, like where stocks only go down. Argentina, they would just laugh. But another big bucket that almost everyone avoids is real assets. So REITs, real estate investment trusts, commodities, commodity type of investments, equities, gold, tips, treasury, inflation protected securities. All these help out when there's inflation or unexpected inflation like there was, although it feels like it's conquered, listeners, TBD if it is. And so if inflation starts creeping up again, you want those things in your portfolio. That's a perfectly fine portfolio. We have 3 allocation funds. So on one end, we have this fund. Said, I'm going to disrupt the asset allocation world. I'm going to offer a no-fee ETF. Excuse me. It's going to own ETFs. It's going to be low cost. It's going to own the global market portfolio with tilts towards value and momentum. It's going to crush everything out there. It's going to be super low fee. That fund is still under 100 million, I think. And so we didn't quite disrupt the world yet, but it is a buy and hold fund. Has done great. The problem with buy and hold is the hold part, right? Like you don't do anything during bear markets. And we've had the last 15 years, we've only had in the US these sort of 20% in rippers, right? The buy the dips. At some point you have, the 50%er and the emotions creep in, and that's really what fractures your process. And God forbid we have another 80+%er like we had in the 30s, but it's possible, or a sideways market for 20 years. That's also possible. But on average, buy and hold, the hardest part is the compliance. And when some asset does better than the others right now, that's US stocks or everything else, you don't want to rebalance into foreign and emerging and bonds and real estate and tips, on and on. So it's a hard strategy to follow when times are tough. On the far flip side, we have what we're most known for 15 years ago was trend following. And trend following as a strategy, esoteric. I think some institutions around the world embrace it. I think to me, it's the most obvious strategy in the world, and one that, if you're going to be completely honest as a quant or others, does the most benefit to add to a traditional buy and hold portfolio versus any other strategy out there. Now, the problem with trend following is if you implement it on your own, I think it's equally as hard as buy and hold because it has a low batting average. Like a Otani would be happy with this batting average. You could have many losing trades in a row. You may not want to take the trades, on and on and on. But even if you allocate to a trend following fund, and we have one, Global Momentum and Trend, the ticker's GMOM, or managed futures is a close first cousin, which goes long and short, 50 or 100 markets around the world based on the trend. You want to be invested in what's going up and not what's going down. So you could be trading cocoa or euro dollar futures or oil, very esoteric markets. The problem with trend following is that when the S&P is going up 15% a year, often you don't look as smart or perform as well. So you could have entire periods like value where you underperform. And so a lot of people struggle with that because they don't like to look different when their neighbor is buying an NVIDIA and Bitcoin and making a ton of money and buying a new car, and you feel really dumb and you go to happy hour and everyone else is talking about how much money they're making. Like, it's the old Buffett Munger where, he says, I can't think of how many times I've heard Warren say it's not fear and greed that drives market, but envy, right? The envy of this cycle is tough. I mean, I saw quite possibly the dumbest, excuse me. I love my crypto friends. I've been a sidelines cheerleader for a long time. You can find a 2013 tweet talking about crypto and Bitcoin and sushi on my Twitter feed. But one of the hallmarks of my crypto friends, and I said this on Twitter, and I said, if I had to invest in just one person or a manager with my money, I would want their number one trait of professional money manager to be humility. Second would be probably curiosity, but number one being humility. And oh my God, is our friends in the crypto world not embrace that concept. But there was someone last night on Twitter that said, Bitcoin's going to hit 100,000. And someone's like, sure, you want to bet? And he's like, yeah, I'll give you 5-1 odds it hits 100,000 by year end. And I'm sitting there thinking, he's just literally handing free money to this person. And he's like, let's bet $100,000 on this. And the smart person, who's a derivatives trader, by the way, was like, sure, I'll take that bet. You're just handing me free fiat. And he's like, that's not the point. And he's like, well, it doesn't matter if it's the point. You're just giving me free, probably $40,000, but I can schedule this in a way that it's actually more like 100 to 200,000 in an upside scenario. Anyway, so looking at trend following and looking at other ideas when other people are making money is tough. Now, that having been said, you will own the things that are going up. So a trend following portfolio would be long US stocks right now. Just the position sizing is going to be a lot smaller than a traditional portfolio because you own 50 to 100 markets. Anyway, long-winded part to say trend following is also hard. So a lot of people want to do one or the other. Market timing gets a bad name, but if you do it quantitatively, rules-based, I think it's actually a very similar methodology as market cap weighting in U.S. stocks. That's another diatribe, but most people want to do one or the other. And we said this Trinity concept, which is sort of our flagship allocation, which is what I do with most of my own money on the public markets, is essentially half in global buy and hold assets with tilts towards value momentum, US, foreign, stocks, bonds, real assets, and half in trend. Now, this trend allocation is larger probably than any professional investor in the world. I don't know an institution that does 50% in trend. I know some that do 10, maybe 20. But looking at it from a purely trying to be honest standpoint, I have a hard time arguing that it shouldn't be half. Now, there's times that trend following looks super different. So trend following contributed mightily in 2022. Guess what? Because it was short bonds. Like you couldn't escape that trade of bonds going from 0% to 5% unless you were short them. There's not much else that helped. But trend following did. And so to me, this sort of yin yang combination of trend and a buy and hold approach works not just from the mathematics of portfolios, not just from thinking about how these assets fit together in strategies, but also from the emotional and psychological side. Because man, there's times when buy and hold's doing terrible and you say, thank the heavens for trend following. So think about the beginning of COVID. You're like, this is going to be the zombie apocalypse. I could see this going down 80%. And you said, thank God for trend following. And then you got to, when the market bottomed and ripped right back up, you say, oh, well, thank goodness for buy and hold because you captured this. And so the two work together. And historically and in real time, you end up with a nice looking portfolio, single digit volatility, which is pretty incredible. I think it'll be around 10% probably on average in the future. But it kind of checks all the diversification boxes and mental, I'm going to muck this up boxes that most of us struggle with, not just individuals, but also pros as well. And to me, that's the whole point is like, it doesn't matter what investing strategy you do so much is are you willing to get to the finish line? Are you willing to maintain? And so many of us can't. We're our own worst enemy when it comes to investing in markets. We're not built for trading futures and options and stocks and bonds, particularly on Robinhood's time frame. but rather it's we want to put in all the guardrails so we behave.
That's a really interesting answer. Thank you for that. I'd love to pivot just for a second and talk about the company, the Cambria as a firm. You have a small team there. I'm interested in what you've learned over the years about the best ways to get the most out of a smaller team.
We say the biggest compliment you can give someone in markets, but also entrepreneurs, is simply you survived. So when you and I are doing this podcast and we're 70, 80 years old and we're looking back and laughing at, all the crazy things that happen in the meantime, I think the biggest takeaway will not be Meb Ben saying, "Hey, do I regret getting 10% instead of 11%?" Who cares? No, I'm not going to even notice that. But would I have regretted taking on a massive amount of risk and leverage and shooting for the fences and having to live through, or probably more likely gone bust, a 50 or 80% drawdown? And that's a mistake I feel like most investors make. They take on more risks. They don't have an investing plan. So as we built Cambria, looks obvious today, but certainly in the other early days, and this applies to every entrepreneur, can certainly sympathize or relate to this comment. There's been plenty of dark periods. There's been plenty of years where the company lost money, where assets were going down. Nobody wanted to invest in funds. Everyone thought we're idiots. We went through a really tough period. My co-founder passing away unexpectedly. So on and on and on. You're faced with these body blows of struggle, but that's the naive optimism every founder must have. When I look at all these investors, I do a lot of private startup investing, and you have to have a naive optimism to believe that you're going to succeed, with the foreknowledge that everyone says most startups fail. Right. And so everyone knows that, but they're like, nah, that's not going to be me. And so, I think trying to survive and build this, as someone who thinks about risk all day long, trying to build a company in a way that makes it robust. The part of the struggle I see with a lot of my friends in this world is, if you only have one or two strategies and you put all your eggs in one basket, like, you need to be willing to fund that and sustain for probably 10 years. And most people see this ETF, oh, like there's going to be a huge pot of gold at the end of the rainbow. I'm going to launch a fund and $1 billion is going to come in. Look, that happens sometimes, very rarely. More than likely, it's going to be a struggle and a battle, and you can't control the returns or the future. And so market regimes, as we've seen, can last a really long time. I was tweeting the other day on X, where I said, man, I've seen a ton of Chinese funds shut down in the past year. And so you see these sort of sentiment indicators. And I texted a friend, I said, how many funds have shut down? He said 18 ETFs. And that's not something you see when markets are hitting all-time highs, right? So I think we went into this saying, look, we want to do this, but with a number of strategies. So we have a tail risk ETF, right? And so the tail, I try to educate our investors and say, look, we want you to be mindful when you're investing in these strategies. It's easiest to invest in what's hot. I've said this before, but I said, of the hundreds of thousands of investors I've talked to over the years, I've talked to so many at happy hour or coffee where they say, Meb, your fund's doing great. You're brilliant. You're handsome. They don't really say that, but this is the gist. They say, your fund's done awesome. Thank you so much. I'm going to add to it or more. What I've never heard once ever was like, Meb, your fund's done much worse than expected. I'm going to add to it. Right? They say, you're an idiot. You're a moron. Why did I invest in you? Why did I listen to Ben or these other people saying you're a smart allocator? I bought this fund. It went down a bunch, and you're a fool. So I'm selling it. When in reality, they should be doing the opposite. They should be saying, okay, no, I need to add to this. I'm on board with the strategy. It makes sense. The fact that it's down is a gift, and rebalancing helps do this. And ditto with things that are going up. I think that's a struggle for most people. Anyway, the point being is that we wanted to diversify across a number of strategies. And so if our tail risk fund is struggling and assets are coming out, because people tend to use that tactically. Going back, circling to the very beginning part of this conversation, you were asking a little bit about, who do we target some of these funds to, and what's the product market fit? Well, in some cases, it's individuals. Some cases, it's institutions. Some cases, it's both. In some cases, it depends. So there's some funds that people use as alternatives. There's some funds that people use as tactically. So the tail risk fund, for example, we tend to see an increased interest when the market's rolling over, starting to go down, because people are wanting to hedge that downtrend or potential down market. But having that diversification at least and helps us sleep a little better at night. If you have one fund, and I have plenty of friends, we have plenty of friends in this world, that only have one fund, and that's hard because you're exposed to one market environment. We know these regimes can last a long time. So to us, that was always an important concept, to try to build it out and hopefully to educate people to be in for the long haul and not chase performance, which, as we've seen, over the course of the cycles, on and on, every year, every decade, with these famous managers that have amazing performance, all the money comes in, and then dollar weighted, they perform terribly, and all the money comes out. We have an old tweet, man, 12 years old, 13, 14 years old at this point, where we said he looked at all the Morningstar managers of the decade in the 2000 to 2010 and how they performed since. They all just absolutely destroyed the stock market in the 2000s, and they all underperformed afterwards. And so looking at sort of allocating and strategies, but also business building, trying to come up with that long-term goal and then work backwards. All right, how do we get there? It's never remotely what it looks like on the framework, but at least it gives you an idea of what to think about and what's possible. That having been said, there's no guarantee that we survive or this is a success going forward, but it certainly feels a little easier today than it did in years past.
And do you have tangible evidence that the podcast has been beneficial to business in some ways, whether it's branding or relationships? Do you feel like the podcast is synergistic with the asset management business?
I think so. It probably also hurts sometimes if somebody comes on and watches me or listens and says, "Wow, that Meb's actually kind of sounds like a dope." That's who I'm investing with. No, I mean, look, if you rewind, my career has been built on content, and others have too. And we use examples in our world of investing. Ken Fisher, certainly, who's now a $200 billion investment firm that is not low fee, by the way. So this low fee disruption has taken out a lot of firms to the graveyard and dustbin of history. Ken Fisher is not one of those. He's been built on content through direct mail, magazine articles, and now online content. Rick Edelman, famous financial advisor, now part of a multi-$100 billion financial complex. He was radio show style. Dave Ramsey, a little more personal finance side, but does hundreds of millions, not a professional manager. In fact, we could spend an hour on that. But content has always been a way to have a megaphone, even pre-internet. And so for us, for me, it started out as academic papers and blog. And, as we both know, like, you have a megaphone, which can make you look really dumb or really smart. And the beauty, going down the academic paper route, used to send it in and submit it, and then you get reviews, and it comes out like 2 years later. So why not just throw it up online? And I'm going to have tens or hundreds of thousands of people tell me why this is really stupid, like, instantly. So we've published over a dozen papers, 5 books, thousands of blog articles, countless tweets and emails. So I think it all helps, and it reaches different people. We even throw stuff up on YouTube, and I've been told on TikTok now, which makes me cringe. But the podcast, certainly as a podcast consumer, certainly I think reaches a different part of your brain. You can do it while gardening or jogging or driving. And so I think it's a fantastic format. I love it. We listen to a lot of podcasts. Certainly, on our free research service called the Idea Farm, we try to curate it, and that now has, 5 years on Spotify, You can find the curated top investment podcasts each week. We do usually like 2 to 3 each week, and my team does it now. But it's a great resource if you want to go listen to 500 plus episodes of the best podcasts over the years. There's some good ones on there. But so I think it helps. But I think part of that, going back to the founding of the firm, was not necessity. It was necessity, not design. So it's not like we sat there and said, okay, we're going to plan on content. We're like, we don't have any money. Like, we can't hire people. We can't market. We don't have any salespeople. We can't do ads. Like, what do we have to do? I think my first client came from me writing an op-ed in the LA Times, which I've neither done before since, I don't know why I chose to do that, um, but content, I think is king in our world. Obviously, there's a lot more competition for not just podcasts, but everything now, and that seems to be shortening, as you and I were talking about in the beginning. But I think it's certainly been helpful.
It's a little dangerous to tackle this topic because I think we could probably do a whole podcast on it. But I wanted to ask you a question you asked your guests. What is one thing you believe about investing that most of your peers in the industry don't?
Well, this is inspired by a tweet thread I have that's now 20 long. And I think we turned it into a summary white paper at this point. But, the concept being is like, if you sit down with your buds, we go surfing or we're at happy hour and we say, all right, and I say something, like everyone at the table is going to shake their head. And, I have a lot. I tend to playfully, I think, they probably don't think so, love to pick on CalPERS, multi-hundred-billion-dollar pension fund located in our home state of California, which seems to always be doing the wrong thing at exactly the wrong time. And so we've written some papers called something like, Should CalPERS be managed by a robot? They have hundreds of employees and spend hundreds of millions on investment managers and fees and administration and on and on. It's this endlessly complicated Rube Goldberg machine of investing. And we kind of demonstrated, I can't say prove in our world, but demonstrate that they would be just as well off if they just bought a buy and hold global portfolio of ETFs. And so I joke with them all the time and I say, look, I've applied for their last 3 CIO openings and they declined to interview me each time, respectfully. But jokingly, I say, look, you hire me, you don't even have to pay me. I'll just rebalance this portfolio once a year. We'll fire everyone, so you got to deal with that. We'll wind down all these, really complicated high fee investments, and we'll put you in a bunch of ETFs, and we'll have a party each year where, we'll invite everyone and we'll rebalance all together. So my non-consensus view is the vast majority of institutions, and this applies to individuals and pros as well, would be better off with a buy and hold globally diversified portfolio. And you can tilt it if you want. You can add value and momentum and trend or whatever you like. You can even add some active managers. I mean, all of our funds are active technically. But starting with this mindset and base case scenario versus the opposite, which is just a mess because these big institutions, and Harvard is now in the same sort of situation over the past. I mean, CalPERS has had like 7 CIOs in the past decade. I mean, how dysfunctional is that? But the problem is there's so many interested parties and it becomes more political than investing related. And Harvard has struggled with this too. And it'll be sadly interesting to see if Yale is able to maintain their culture of significant, massive outperformance based on the late, great David Swinson, or whether they'll succumb to some of the challenges too. So I think this mindset of thinking about the portfolio, and we tell everyone this, we say, get out a piece of paper, wipe your portfolio, write down what you think the ideal portfolio looks like today and structure how you're going to rebalance it, what are you going to do with it, and then compare it to what you own. And most people, they own a large legacy laundry list of garbage, just absolute garbage that if they had to go buy it again today, they would say, are you crazy? Like, why would I? No way would I buy these dog crap companies or strategies or styles. So I think to me, that's a big one. I think it's applies to everyone, whether they want to hear it or not.
Well, Meb, I could talk to you for a couple hours, but we're gonna have to close. And I'm gonna like slightly tweak my typical close question. We always ask about something that's underappreciated. I know it's hard for you to choose between your children, but I'm curious if there's an ETF you think offers something really compelling that people don't really appreciate yet.
Sure. So, I've got a couple ideas I want to go with here. All right. So we already talked about EYLD, which is usually my answer because that's a single digit PE ratio. It's got a double digit shareholder yield, and looks marvelous in my mind. Cheap, hated, and in an uptrend. There's a kicker that it owns a big giant slug of Russian securities, which are marked at zero on the fund's NAV. So you also have about a 10 percentage point call option, free call option, if Russian securities ever trade again. Who knows when that'll be? Hopefully there's peace in the Middle East and Asia, and that transpires this year, but it could be 2026, 2030. So I'm not going to answer that. I'm going to answer with arguably our weirdest fund. Actually, you know what? I'm going to answer with our newest fund, because I'm historically not a fixed income guy. I think a lot about fixed income, but coming from an outsider on this, if you look at bonds, so for a long time, bonds yielded nothing, which was weird already. ZERP, NERP, sovereigns in other countries yielding negative. Like that was a weird time. And all of a sudden now you have this like retiree lottery. These bonds have gone from 0 to 5%. So all of a sudden you can get 5% for doing nothing. Hallelujah. Let's go to Cancun, drink pina coladas on the beach and earn 5% on our money. And this is T-bills, risk-free asset, right? But I kind of scratch my head and I think, well, once you look at, say, bonds, there's not just T-bills. There's longer duration maturity bonds in the US, so 10 or 30-year bonds. You have corporate bonds that give you credit risk, junk bonds. You have emerging market bonds. You have TIPS. You have quasi-income stuff like REITs, on and on. So once you see this magical 5%, you're like, well, what about all these other things, these shiny objects? And the thing that I've always struggled with and scratched my head up about, I said, as a value guy, and this probably resonates with you, I don't understand if bonds hypothetically yield 5% T-bills, and we have what's called this inverted yield curve. So the 10 or 30-year bond actually yield less than T-bills. Why would you buy 10 or 30 years? Now, there's some arguments, like if you expect bond yields to go down, you're probably better off in a 30-year bond, perhaps. But on average, it doesn't make a whole lot of sense. An easier way to frame this is say, all right, let's say I'm a junk bond salesman. And I say, here, you can buy junk bonds for 5% right now. You say, well, why in the world would I do that? I can get 5% in T-bills. Or you say, well, all right, well, how about these junk bonds at 3%? You say, that's really crazy. Like, why would you do that? But what if I said, well, maybe junk bonds at 12%? You say, okay, now we're talking, right? So we went through and modeled all this. Now, a way to think about this is a very well-known concept called carry, which is investing in things that yield more. Now, you can do that within an asset. You can do it across assets. This has been well-known for decades. But I was really kind of going to, the nerd would say, time series carry, meaning if I looked at the 10-year or 30-year US bond, what if I only invested in it when it was in the top half of yield by history? So, and only history up till that point. So we're not trying to do a look ahead bias. But we basically don't want to invest in the 30-year bond if it's yielding less than T-bills. And historically, you model that out, and sure enough, you end up with usually a higher return, lower volatility. So you chill out in T-bills unless the 30-year yields in the top half of history, then you invest in the 30-year. But then you can do this for every bucket of bonds. And so we launched this fund called Tactical Yield, TYLD, where it just chills out in T-bills, and there's about 10 sleeves where if any one of these sleeves blows out to a high spread, it'll invest in it. It's kind of like a Howard Marks, Oaktree sort of style investing. And but it does it quantitatively and systematically. Now, right now, despite the large drawdowns in many bonds and bond aggregates, it's 100% in T-bills. At some point, you either need to have T-bill yields coming down or all these other yields going up, which would require those bonds to go down even more. So we'll see when that environment happens. But this is a fun strategy and idea because it's kind of targeting like T-bills, but plus a little juice when it warrants, investing in something riskier. I've never seen anything quite like it. There's some ideas in academia that are kind of like this, so it'll be fun to see if this idea has merit or it's really dumb. We have a paper that just came out on the topic. We can send to you, and you can rip it to shreds. But the idea being T-bills and chill most of the time, unless you're getting rewarded for taking on some additional risk. It's kind of like a classic value strategy with stocks where Buffett's like, wait for the fat pitch. You can hang out. You don't have to invest. He's got a big slug of cash right now. But when you get a fat pitch, then maybe move into something a little more interesting.
Well, Meb, I love that we finished.
You like I worked in two? Sorry.
Yeah, no, that was great. I love that we finished on fixed income because we sure haven't talked a lot about fixed income on the entire history of this podcast. So
yeah, me either.
I appreciate you getting that in there. And, more so just thanks for being on the show. I've been looking forward to this. And, I've learned a lot about Cambria that I didn't know. So thanks for doing that.
Yeah, it was a lot of fun. We'll have to hang out in the real world. Listeners, maybe we can do a Los Angeles-based meetup, and all you guys can come hang out and listen to all the stuff we can't say on the podcast, but can say in real life.
Totally. When it gets a little warmer, we should do it in the South Bay.
Sure.
Meb, thanks for doing this.
It was a blast. Thanks for being here.
Meb mentioned a number of ETFs on this podcast. I do not own any of them.